Welcome to Corporate Finance. My name is Natasha Sexton and today I'll be taking you through the topic on dividend policy. Today we plan to answer one fundamental question. Do dividends really matter? Do they matter to shareholders? Do they matter to the market? Do they matter to analysts? And this is what we're going to discuss over the next couple of minutes. Our outcomes regarding this topic is going to be to understand the different dividend policies and how these policies impact on potential shareholder decisions, as well as to assess the impact of these policies on future and existing shareholders. These outcomes will be addressed not only in this session that we're going to be talking through, but also through doing the case study, which is linked to dividend policy within the MBA module. What is a dividend? To answer the question, do dividends really matter, we first need to understand what is a dividend. Well, a dividend is a payout of the company's profits to its shareholders. This can come in many different forms, being cash, being a split of the existing shares, but it's any value that the shareholder gets out of the company that's not capital growth. So we've actually decided to play it. This can be depicted in the picture which is on the slide. It says the shareholder has an investment, so up front we invest in a share on the stock exchange. The company then actually goes through actions and operates, and profits are made. Once profits are made, the owners of the directors of the company have a choice. They can either pay out a dividend to the shareholders or decide not to pay a dividend and keep the money inside the entity and reinvest that money into earning future potential of the company, which will increase capital wealth of the shareholder. This decision of how much to pay out or how much to retain in a company is taken by the directors, and that is called dividend policy. What may happen is, as a shareholder, I may receive a dividend and then I have a choice. I can either go and spend that money or I can reinvest it in the business. The question is then, do dividends really matter? If I decide to reinvest that money in the business, whether the money is paid out by the actual directors who decide to pay out a dividend, or I take it and go buy additional shares and then reinvest in the business, there's no difference. The company will have the money. So whether I as the shareholder get that value by actually capital growth, which I've then reinvested in the business, or it's paid out, ultimately there'd be no effect. So you would think, no, dividends really don't matter. However, dividends have a significant impact on the message that they're sending to the market. It says the company is performing really well, so the directors decide to actually give that money to the shareholders to increase shareholder wealth, saying we don't need all this money in the business to actually generate future revenues. We can pay some out and still have sufficient for future projects. It also implies that there are future investment plans, so we're trying to give you capital growth, but it's okay, there's enough in the pot to pay some out. It also says we realize that today's investor doesn't just want dividends, but also wants to increase the shareholder value. And as a shareholder, I might want short-term profit taking. So a dividend policy on the current market that's worldwide is that it is actually saying that there are funds in the entity. What's the issue really? Perception is reality. So what the market actually perceives in a dividend is the reality. So the message we're sending by not paying dividends when all the other companies in the sector are paying dividends is we actually don't have funds to pay you. As a shareholder, I might then decide to move my investment to a different share where I know I'm going to get that dividend. So investors in today's market are demanding both capital as well as dividends. It's not enough for a company just to give capital benefits, as was the case in the technology sector for many years. If you think of the IBMs and you think of the Microsofts of the world, for a very long period of time, people were happy to just have the shares, have that capital growth because share prices were rocketing, and then just to sell their shares and make a profit. Some investors actually need that dividend income, despite the fact that this is what the market of today is saying. For example, if I was a person who was retired and I needed some income and a steady stream of income, I might want dividends so I have that cash flow and decide not to reinvest. So it really is, in today's market, critical that companies do pay dividends because it's what shareholders are actually demanding. In this Money article, Simon Lambert expressly said that dividends are the unsung hero of many an investor's portfolio, which made for interesting reading because what it said is that often people take that dividend and spend it. But if you take that dividend and reinvest in capital, I think the example they used was just government gilts. Over a period of 20 years, you could almost get a 4,000% return on that actual amount that you had invested. So by just taking your dividend and reinvesting it, you can increase your capital growth. So in today's economy, dividends are now forming part of a shareholder's means to increase their capital by reinvesting those dividends that are paid out, which has become the norm. Let's take an example. If you look at United Utilities, it's the UK's largest listed water company. The OFAT ruling was that price decreases had to be implemented and capital investments had to be made by United Utilities was made on the 26th of November 2009. This is an interesting concept. If I was a shareholder of United Utilities and I heard that the company that I've invested in has to decrease the prices of sales and has to incur significant capital investment, I would be worried because it implies that I'm going to be losing out on money as the shareholder, which actually was the case. The share price then decreased when that point in time. What happened is in the past they had a historical payout policy of 2% growth in that dividend per annum. So they had guaranteed their shareholders a dividend of 2% in the past, which of a fixed percentage which would grow by 2% each year. What happened is with this announcement of the OFAT ruling, the market anticipated between a 20 and 25% decrease in the dividends as a result of the fact that United Utilities actually had to fund this investment and the decreased prices. When they finally said in early 2010 that they will actually only be decreasing the dividend at 12.5% instead of the initial anticipated 20 to 25%, there was actually an increase in the share price, thereby reinforcing this principle of the market perception is the reality. And what people are thinking is that the share price is affected by the dividends payout and that the shareholders are definitely demanding those dividends. So it does answer that question of dividends do matter. How do we manage those market perceptions? Well, the first thing is to have very clear communication of what your future plans are in terms of capital investment, in terms of actually paying dividends. But then it's to actually make sure you maintain those communications and actually pay out what you say you're going to pay out. The message you send when you say initially there will be a dividend and it doesn't get paid out is that things are really rocky in this company. So it is critical to deliver on those promises. Another means of communication that companies use is that they actually say our dividend policy is X, which is a clear form of communication that shareholders can expect over the next 5 or 10 years, or at least for the next year. This is what we plan to do. The different dividend policies that companies can implement are as follows. The first one is a fixed payout percentage. This is the policy where every year you pay out a fixed percentage of the profits earned to your shareholders. Let's look at an example. If I as a company earned £100 profit and I said that my payout ratio was 5%, that would mean that I would pay out £5 as a dividend to my shareholders. This is a great policy because it's very determinable by the shareholders. They can actually see what's coming, but it also actually reflects the earnings. So if there was an increase or decrease in earnings, the dividend will reflect the performance of the entity. However, it's not a fixed amount, so shareholders can't be determined of what's coming. The second option is zero permanent payout. Well, this is easy. Well, it's got no impact, no calculation. Shareholders know exactly where they stand. However, in the current market where investors are demanding capital as well as dividends, it's imperative that you think about this policy before implementing it. Because as a shareholder, I might actually decide to move my investment to a different share based on the fact that I'm not getting dividends, whereas in another company I actually am. The last option is a constant or steadily increasing dividend that is paid. This isn't a percentage of profits, but rather a fixed amount of pounds or pence that a person who's a shareholder can guarantee on. So if, for example, I say that I will pay 5 pence to my shareholders, increasing at a growth rate of 2% per year, as the shareholder, I can know that next year I'll at least get the 5 pence plus the 2%, and the year following that, and on that. It remains constant or it increases. The disadvantage of this policy is that it doesn't really reflect the performance of a company. Whether you have a good or bad year, the actual shareholders can expect a consistent dividend. This is the most commonly applied policy, which you will see in most shares that are on the stock market. But each of these policies have their own advantages and disadvantages. The question is, you need to figure out what works best for your company and what's the message you want to send to the market, what perception is out there. So let's recap. Investors today want, as well as demand, both capital and dividends on their investments in shares. And if they're not getting it, they are actually going to move. Dividends are definitely relevant and do matter. And one of the best tools to actually manage those market perceptions is to have a communicated, clear dividend policy. So yes, dividends do really matter. Thank you for your attention, and we look forward to seeing you again soon.